Hello everyone. I will continue with rest of chapter 5 in this lecture. So far we looked at portfolio diversification as a way to reduce risk. But diversification does not eliminate risk entirely. So we need to understand why all risks are not eliminated and what are the implications for our investment. So risk consists of two parts. The first one is the diversifiable risk. So what happens is when we have multiple assets in a portfolio and they are negatively correlated, so they cancel or they minimize the risk of the portfolio. So what we are actually doing is we are reducing the diversifiable risk. But there is also a component of the risk which is undiversifiable. This is This risk is inherent in any investment because of macroeconomic factors, political factors, and so on. And this is called the market risk. So the total risk is the sum of diversifiable and undiversifiable risk. So in this section, we will look at undiversified risk. So beta is a measure of undiversified risk. It indicates how a security changes with respect to changes in market returns. So in this case, the stock of Bank of America has a beta of 1.2, which means that if market return changes by certain amount, the change in the return of Bank of America would be 1.2 times of the market change in market return. Similarly, the beta for PepsiCo is 0.6, means for a given change in market return, the change in PepsiCo's return will be 60% of that. So what is beta? It is a measure of the undiversified risk. The beta for the overall market is 1 because the concept is change with respect to changes in the overall market. Hence, the beta for the overall market itself is 1. The stocks may have positive or negative beta. Positive beta means positive change in the market return will lead to positive change in the stock return. And negative beta means positive change in market return will lead to negative change in stock return. So these are some of the interpretation of different beta. Beta equal to +2 means twice the amount of change in market returns. Beta of -0.5 means half of the change of market return, but in the opposite direction. So these are some sample beta of leading companies in the US. So how do we interpret beta? If beta is 1.5, it means that the changes will be 1.5 times that of the change in the market. If market return goes up by 10%, stock return will increase by 15%. Similarly, if it falls by 10%, it will also, the market return falls by 10%, stock return will fall by 15%. Beta greater than 1 means these stocks respond more to market changes and hence are more risky. Beta less than 1 means these stocks have return which changes less as compared to market changes. So they are considered less risky. So how do we connect beta with expected return? So the assumption here is diversifiable risk can be eliminated or minimized through a suitable portfolio. We are comparing beta or undiversified risk with the expected return. So expected return means risk-free rate plus risk premium. The risk premium is beta into the expected market return minus the risk. So now what we do is we plot the expected return from the formula in the previous slide against different values of beta for a stock. So this gives us the security market line. So here we have one stock, different levels of beta, and how that changes the expected return from that stock. So when we take different values of beta, calculate the corresponding expected return and plot it in a graph, we get the security market. So this is the security market line for a particular stock. So we know different values of beta. We have calculated the corresponding expected return, plotted beta and expected return, and then we get a straight line. This straight line is called the security market line. So why is beta or this capital asset pricing model popular? Because it is a very intuitive framework and helps to link risk with return. And it is widely used in corporate finance for investment decisions or to find the required rate of return. But there are certain limitations. This model estimates beta on the basis of historical data. And historical data may not predict future returns or future stock movements correctly. So now we move on to traditional portfolio approach and modern portfolio approach. So what is traditional portfolio approach? This approach emphasizes on creating a portfolio with stocks from different industries and well-known stocks of well-known companies from different industries. The idea is that stocks from different industries will help to diversify the risk and reduce it. Having well-known companies means they are less risky compared to smaller companies. Their stocks are available and also liquid, so they can be easily sold or bought. And another reason is it also provides comfort or assurance to the investors that the portfolio has invested in good stocks. So this is typical portfolio of a fund which has invested across different sectors. Now, what we notice is that the previous fund as well as another fund, that is Fidelity Contra Fund, their returns are highly correlated because they may hold similar portfolios. So this shows that the traditional approach to portfolio management leads to a herd mentality. Different investors, different investment management companies want to create similar portfolios because they think that they will earn similar returns. However, most modern portfolio theory has a different approach. So it does not look at different sectors and well-known companies within those sectors. Rather, it looks at the expected returns, standard deviation, and correlation between different assets. The assets which are considered to be included in the portfolio. So using those assets and the information about them, we try to create different combinations and try to find an optimal portfolio among those combinations. We generally see that the maximum benefit of diversification occurs when the securities are relatively uncorrelated. So modern portfolio theory requires us to create an efficient frontier. So this is different portfolios created by different percentage contribution of assets. Each portfolio will have a risk return trade-off. Maximum return compared to the risk assumed by the portfolio. So when we plot the maximum risk return trade-off for each portfolio, we get the efficient frontier. The efficient frontier here is BYOZC, the curved line in bold. So we are plotting the portfolio return versus portfolio risk. Any portfolio below the efficient frontier is feasible or possible, but it gives a lower risk return trade-off. Whereas any portfolio above or to the left of the efficient frontier is not possible, because any portfolio above the frontier means it provides higher risk compared to the higher return compared to the risk. But the efficient frontier is the maximum possible return for a given risk. So any portfolio above it or to the left of it is not possible. Now what we do is we create indifference curves. Indifference curve means it is a level of satisfaction for the investor for different risk return combination. So the investor gets the same amount of satisfaction from different risk return combinations and hence is indifferent between any of these combinations. Now what we do is we plot the indifference curves, and the point at which an investor's indifference curve is tangent to the efficient frontier at the highest level, that is the optimal portfolio. So in this graph, if you see I1, I2, I3 are different indifference curves. I1 is one level of satisfaction, which is possible through different risk return combination. Similarly, I2, another level of satisfaction possible through different risk return combination. Now, when we plot these indifference curves, we look at the highest point at which an indifference curve is tangent to the efficient frontier. In this case, O is the point where indifference curves are tangent to the efficient frontier at the highest level. So O is the optimal portfolio for the investor. So what does modern portfolio theory say? It says that when we are combining assets, we are actually also combining their betas. There is no reward for bearing diversifiable risk because the diversifiable risk is eliminated or minimized through portfolio diversification. So what happens is, as we add securities to a portfolio with higher number of securities, the diversified risk decreases. That is what portfolio diversification is all about. So we calculate the portfolio beta because that is important. Diversifiable risk can be eliminated. Undiversified risk will remain. So whatever is the combination of assets in the portfolio, the weighted average of their respective beta is the portfolio beta. For example, portfolio of technology stocks, different contribution of different assets and their respective beta. So the weighted average of the stocks beta gives us the portfolio beta. One is technology portfolio, the other is consumer goods portfolio. So we calculate the beta for the two portfolios. So what is portfolio beta? It has the same interpretation as stock beta. So it gives us the degree to which the portfolio return will change for a given change in market returns. Portfolio beta of 2 means twice the change in portfolio returns compared to a given change in market returns. -1 means the same change as market return but the portfolio return will change in the opposite direction. So we have two approaches to portfolio management. Traditional management is about diversifying across different industry sectors and selecting the blue chip companies. Modern portfolio theory is about looking at the characteristics of different assets, combining them, and then trying to find an optimal portfolio. So how do we reconcile or combine these two approaches so that we have a feasible approach for investors? So first is we have to understand the risk tolerance or the risk appetite of the investor. Then we can try to select securities in different industries. So we are actually following the traditional approach. Then we will look at the correlation between different securities. So that will help us understand the portfolio risk, whether the portfolio is able to minimize diversified risk. Then we look at the beta portfolio. Beta portfolio is the measure of risk exposure, the measure of undiversifiable risk exposure. And we look at the expected return from the portfolio. Now we'll compare the risk return trade-off and then figure out whether it is suitable for the investor, given that we already know the risk appetite of the investor. So this is one practical way in which traditional as well as modern approach to portfolio management can be combined. So that's all for Chapter 5. I'll stop here. Thank you.